I ran the exact same numbers on a $50,000 investment in both the S&P 500 and a rental property, and the results honestly surprised me. Most people argue about this based on feelings or what their uncle told them at Thanksgiving, but I wanted the actual math. So today, I'm breaking down a real 10-year scenario with all the taxes, fees, and hidden costs included, because that's where the truth lives. By the end of this, you'll know exactly which path makes sense for your money. Let's start with stocks, because the math is cleaner. You take that $50,000, drop it into an S&P 500 index fund, and historically, you're looking at about 8% annual returns with a 1.5% dividend yield. Now, you're paying maybe 0.05% in fees if you're using something like Vanguard or Fidelity, which is basically nothing. Over 10 years, with dividends reinvested, that $50,000 compounds to roughly $108,000 before taxes. After you pay long-term capital gains at, let's say, 15%, you're walking away with about $93,000 net. The beautiful part is, you did absolutely nothing except click a button once. Now, real estate is where it gets interesting, and this is what most people get wrong. That same $50,000 becomes a 20% down payment on a $250,000 rental property. You're financing $200,000 at 6.5% on a 30-year mortgage, which means your monthly payment is about $1,264 in principal and interest. If the property is in a market with a 7% cap rate, you're pulling in roughly $1,458 per month in rent, or $17,500 per year. After you account for 30% in operating expenses like maintenance, property management, insurance, and vacancy, your net operating income is around $12,250 annually. Subtract your mortgage payment of $15,168, and your cash flow is actually negative $2,118 per year in the early years. But here's where leverage does its magic. That property is appreciating at 5% per year on the full $250,000 value, not just your $50,000 down payment. So you're gaining $12,500 in equity from appreciation alone every year. Plus you're paying down about $30,200 in principal in year one, which increases each year. Add in depreciation shielding roughly $9,091 of ordinary income from taxes, and suddenly the after-tax picture looks completely different. After 10 years, the property is worth about $407,000, you owe around $164,000, and your equity position is $243,000. Even after paying depreciation, recapture, and capital gains when you sell, you're netting somewhere around $210,000. That's more than double the stock scenario. Now, before you run out and buy a rental property, let's talk about what this actually costs you beyond money. Stocks are completely liquid. You can sell in seconds during market hours and have cash in 2 days. Real estate? You're looking at 30 to 90 days minimum, plus 6% in selling costs, plus the emotional nightmare of dealing with buyers. I want to be very clear about this. Real estate ties up your capital and your time. You're dealing with tenant calls at 11 p.m. about broken water heaters, you're managing vacancies, you're worrying about whether the HVAC system is going to die. Even with a property manager taking 8 to 10% of your rent, you're still the one ultimately responsible. Stocks sit there quietly compounding while you sleep. The other thing is risk concentration. That $50,000 in stocks is spread across 500 companies in different sectors. Your rental property is one building in one neighborhood in one city. If that area goes downhill, or if interest rates spike and cap rates expand, your property value can stagnate or drop while you're still making mortgage payments. What's really interesting is the sensitivity here. If mortgage rates were 4% instead of 6.5%, real estate wins by an even bigger margin. But if rates hit 8% or cap rates compress to 5%, suddenly stocks start looking a lot better. At the end of the day, the decision rule is simple. If you can get positive leverage where your cap rate exceeds your mortgage rate and you're willing to put in the work, real estate wins on pure returns. If you value liquidity, diversification, and zero effort, or if the spread between cap rates and mortgage rates is thin, stocks are the smarter play. So with that said, here's what I'd do with $50,000 today. If I had the time and the market fundamentals were right, meaning I could find a property where the cap rate is at least 1.5% above my mortgage rate. I'd go real estate for the leveraged returns. But if I wanted to deploy capital quickly, stay diversified, and not deal with tenants, I'd put it in index funds and sleep well at night. The reality is, the best investors do both. Run your own numbers with your local market, your tax bracket, and your personal risk tolerance, and the math will tell you exactly what to do.